Most people think the United States runs purely on taxes, trade, and economic growth. But beneath that surface, the engine of the country hums on something far less obvious: debt. Not the kind you carry on a credit card, but a system of government-created obligations. Promises to pay with money that doesn't exist yet. This is the story of how the US mastered the art of borrowing from itself, turning government debt into a tool of power, policy, and global influence. When the government spends more than it earns, it doesn't dip into a secret reserve. Instead, it issues bonds, treasury bills, notes, and bonds. Each one is essentially a promise. Lend us money now, and we'll repay you later with interest. Investors buy them because they are considered among the safest assets in the world. But the real twist is that the biggest buyer of these bonds, isn't a foreign nation, it's the United States itself. Through the Federal Reserve, the government has transformed borrowing into a self-sustaining cycle. The roots of this system trace back to 1913. When the Federal Reserve was established just before World War I. Back then, money was tied to gold, which limited how much the government could print. But war demands overwhelmed gold reserves. So the government issued bonds and let the Fed purchase them, creating new dollars in the process. Those dollars funded the war effort, and after the conflict ended, the practice stuck. The bond market quietly became a powerful mechanism for funding the state. Here's how the cycle works today. The Treasury issues bonds. Investors buy them, and those bonds circulate as collateral throughout the financial system. The Federal Reserve can then step in, buying some of those bonds from the market with newly created money. That money flows back into the economy, increasing liquidity, credit, and spending. On paper, it looks orderly, but in reality, the government is borrowing from itself. The left hand writes the IOU, and the right hand accepts it as payment. This system grew in scale during the 1940s, when wartime debt reached unprecedented levels. The Fed helped keep interest rates low, allowing the government to borrow cheaply. After the war, the Fed and Treasury formalized a relationship. The Fed would operate independently, but remain ready to intervene during crises. That agreement became the foundation of modern U.S. monetary policy. The 1971 severing of the dollar's tie to gold under President Nixon changed the game entirely. From that point on, the dollar was backed only by faith. The government could issue debt or print money without physical limitations, and the bond market expanded rapidly. Bonds were no longer promises to pay in gold, they were promises to pay in dollars, which the government could always create. Debt had no ceiling, and the Fed gained unparalleled influence over the economy. Over the following decades, U.S. treasuries became the bedrock of global finance. Banks, investors, and governments worldwide trusted the United States to honor its debts. And this trust allowed the government to borrow continuously. By 2008, total U.S. debt surpassed $10 trillion. Then the financial crisis struck. The housing market collapsed. Banks froze, and markets teetered on the edge of collapse. The Fed launched quantitative easing, buying trillions in bonds to stabilize the system. This was essentially the bond trick on steroids. New money was created to purchase government debt, raising bond prices, lowering interest rates, and enabling more borrowing across the economy. While effective in the short term, this process reinforced a cycle of growing debt. Every economic slowdown led to new bond issuance, and every market shock prompted Fed intervention. Today, the U.S. owes over $34 trillion. Yet every auction of Treasury bonds finds eager buyers, largely because the Fed underwrites confidence in the system. Why would a government buy its own debt? At first glance, it seems circular, but the mechanism relies on perception. Bonds are treated as savings instruments for the public and policy tools for the Fed. By creating demand, the Fed controls interest rates. Lower rates make borrowing cheaper, allowing more spending and supporting economic growth. The cycle is self-reinforcing, almost like pulling oneself up by one's own shoelaces. This strategy also reinforces U.S. global influence. Nations seeking a safe reserve invest in U.S. bonds, keeping the dollar strong. Dollars spent abroad eventually return to the Treasury market, allowing the U.S. to run persistent deficits without losing credibility. But every advantage comes with costs. The Fed's balance sheet has ballooned from under $1 trillion in 2007 to over $8 trillion today, largely filled with government debt. When interest rates rise, bond values drop, creating potential losses. The cycle relies entirely on public and market confidence. The bond trick doesn't just fund government spending, it shapes wealth distribution. Investors and financial institutions benefit first from newly created money, using it to acquire assets before prices rise. Ordinary people experience inflation later, after asset prices have already increased. The cycle deepens inequality and strengthens the alliance between Wall Street and Washington. While ordinary households bear the hidden costs, debt-driven policy also affects political behavior. Lawmakers can promise spending without immediate financial consequences because the Fed helps absorb the debt. Fiscal discipline fades, and deficits are normalized. As the Fed purchases bonds, money flows into the financial system before reaching the wider economy, favoring capital owners over wage earners. Over time, this structural bias amplifies wealth concentration. The growth of U.S. debt reflects this pattern. In 1980, debt was under $1 trillion. By 2000, it reached $5 trillion. After 2008, it doubled again. Each increase followed a crisis, with new borrowing presented as the solution. Debt-to-GDP ratios climbed relentlessly. Yet collapse has been avoided because the U.S. controls the world's reserve currency. Unlike other nations, it can issue debt in its own currency without risk of default. Still, this safety depends entirely on belief. If confidence falters, yields rise, interest costs increase, and the cycle becomes more precarious. Foreign buyers, who once held vast amounts of U.S. debt, are gradually reducing their exposure. Domestic institutions, led by the Fed, now fill the gap. The global economy has become dependent on these interventions, responding like a patient to medicine. Miss a dose, and financial symptoms appear. Domestically, the bond trick influences elections and markets. Central bank actions dictate borrowing costs, asset prices, and economic growth. Meanwhile, public discourse simplifies these issues into debates about debt ceilings or deficits, masking the complexity of the system. The bond market has become both a tool and a driver of policy, shaping wealth, behavior, and expectations. Globally, the bond trick acts as a lever. U.S. monetary policy reverberates across the world, affecting emerging markets, trade flows, and capital movement. Every adjustment, whether printing more money or tightening liquidity, transmits effects to economies tied to the dollar, creating dependency and vulnerability. Nations seek alternatives, from gold to regional currencies, attempting to reduce reliance on U.S. financial policy. Meanwhile, domestically, debt has become normalized. Each crisis triggers more borrowing and intervention, reinforcing complacency. Inflation quietly erodes purchasing power, benefiting asset owners and disadvantaging savers. The system grows more fragile with every expansion, as rising rates can devalue bonds and destabilize banks. This financial cycle, while supporting markets, amplifies inequality and risk. Looking forward, the sustainability of this system depends entirely on belief. Confidence in U.S. bonds keeps yields manageable and debt service costs controllable. If belief weakens, rates climb, interest obligations rise, and the cycle may reach a tipping point. Fiscal reforms, balanced budgets, or modern monetary theories offer possible solutions. But political and social realities often favor continued borrowing. The bond trick has created a global empire without traditional colonies. Every dollar earned abroad, reinvested in treasuries, finances American spending, imports, and military operations. This network functions as a silent tribute system, sustained by trust. But cracks are appearing as countries explore alternatives and question dependence on U.S. monetary policy. Domestically, the trick reshapes expectations. Debt is no longer a warning. It is standard practice. Inflation acts as a hidden tax, subtly transferring wealth from wage earners to asset holders. Recessions and crises are managed by issuing new debt and buying bonds, reinforcing dependence on the system. The bond trick keeps the economy afloat, but makes it increasingly vulnerable to shocks. Ultimately, the entire model relies on confidence. Faith in the system, in U.S. bonds, and in the Fed's ability to intervene, sustains this vast self-financed debt apparatus. But history shows that even the most sophisticated financial strategies can fail if belief falters. Understanding this cycle is crucial, not to panic, but to prepare. The U.S. may continue buying its own debt, but global participation is key. If confidence erodes, the true cost of the bond trick will no longer remain hidden, revealing the fragility behind the world's most influential financial system. Hey everyone! If you enjoyed this video and want to stay updated with more insights on finance, make sure to subscribe to my channel, Financial Coin, and don't forget to hit that bell icon so you never miss our latest videos.